Welcome to Non-Beta Alpha, your source for unique insights and current market trends, with your host, Ryan Morfin, CEO of Wentworth Management Services. Today, we'll be discussing hedged equity investments and how we can hedge beta risk out of our portfolios. We're joined by Randy Swan, the CEO of Swan Investments.
Welcome to Season 4, Episode 1 of Non-Beta Alpha. On today's episode, we have Randy Swan from Swan Investments, a hedged equity investment shop, calling in from Colorado today to talk to us about hedging out our beta risk. Randy, welcome to the show. Thanks for joining us.
It's great to be here with you today.
Well, a lot of investors are starting to get nervous about valuations in the market. Modern monetary theory is continuing to pour money into financial assets. As it relates to your defined risk model, how are you looking at the markets today, and what should financial advisors be thinking about?
Well, we've always taken a long-term approach at Swan Global, and really it goes back to the kind of genesis of the strategy back in the late 90s during the dot-com bubble. Here you had a bubble developing. Alan Greenspan said that favors, quote, irrational exuberance in late 96, and yet the market took about 3.5 years after that to kind of top out. So I think it fundamentally goes back to, can you really time the market? I think it's very difficult. Now, we look at some of the structural issues right now in the market in terms of long-term demographics and the amount of debt that we've added, especially since COVID came out. It really just questions, what's next in the markets? How are we going to unwind from all these extreme amount of debt that we've put on the books over the last several decades, and it just really puts a lot of risk in the question with investors today. How are they going to reach their goals?
Yeah, I mean, the market's been trading in a range, and it seems like it's starting to maybe reallocate. I mean, Morgan Stanley made a call last week that they think we're going to have a 10% correction this year as the leaders of the industry, which is mainly tech and FANG, start to reallocate towards places like healthcare and some consumer durables. What data points do you guys look at in the marketplace to determine the health? Like, what's your perspective, and what KPIs do you guys tend to focus on?
Well, fundamentally, we're always invested, but always hedged. So we don't necessarily change our strategy based on the market conditions. That being said, and I think we're going to get into this a little later. I mean, some of the metrics out there are just completely off the charts, 100 percentile in terms of valuation richness and stuff like that. So, fundamentally, we're doing something right now in the global economy that, quite frankly, we've never really gone through, and we're going to see how this is going to play out. I just don't know, how and when that's going to really seriously affect investors' ability to be able to make money and sustain these levels. But I'm fundamentally go back to the basics of the economy. How the economy is going to continue to grow. The market's obviously gone up a lot over the last decade or so, and is that really sustainable going forward is the main question.
Yeah, and the other side of the coin on a lot of investors' allocation models is fixed income, and it seems that we've been in a very bull market, low rate environment, but a lot of folks that have been investing professionally, pre-1981 aren't in the business today. And can you maybe talk a little bit about the historical context of what a bear market in rates looks like, and when and if we should be expecting a tipping point from the secular trend that we're in today?
You're right. Well, we've had a long-term bull market in bonds. Of course, we don't know exactly if it's bottomed out, but I think I could make a compelling case that last March was the bottom in yields, and we've started rising since then. And as you probably know, interest rate cycles are very long-term in nature, typically multiple decades, if not more. So it really puts investors in a very difficult position right now, because traditionally the 60-40 portfolio, which is really kind of the staple portfolio that we've been using it for decades for financial advisors and individuals, you really have one of those components, the fixed income component, really not being able to generate the types of returns that it has historically. And so when that happens, and it obviously has happened in terms of low interest rate nature that we're in right now, it makes it very difficult to reach your goals as an investor. I think people have responded by really adding more risk to their portfolio.
Yeah, no, we're going to talk about that in a moment, just the step up in risk that people are taking. Do you think the 60-40 model is dead? I mean, do people need to be looking at more of a pension endowment type of model, or is it an aberration of low interest rates and you think 60-40 comes back?
Well, I think there's two things. One, I think the 60-40 portfolio at this point in time is dead. It can't help clients reach their goals and objectives. I think the other fundamental problem with the 60-40 portfolio, which is one of the reasons why we kind of launched the defined risk strategy in the late 90s, was really you really can't count on the different asset classes in that 60-40 portfolio to really be inversely correlated. I mean, we all want everything to go up all the time, but one of the components of diversification or modern portfolio theory is that you want bonds to be able to go up when stocks go down. And I just don't think that's really likely or possible at this point in time. So it does kind of expose one of the structural weaknesses of how to manage risk. And of course, the hedged equity strategy is always based on buying an option to protect the underlying equity portfolio. And we know those things are absolutely inversely correlated when the markets go down. And it's just a more cost-effective, efficient way, but also something that you can actually count on versus hoping that fixed income goes up in value when equities go down.
And that's a great comment and interesting point that, in an age of central bankers tinkering with the markets, there may not be the inverse correlation from fixed income to offset the losses in an equity market meltdown. And so having a hedge product is really a very smart way to play modern monetary theory.
Yeah, absolutely. And like I said earlier, we don't know how this thing is going to play out. Obviously, the equity markets have been on a tear really since the financial crisis in 2009. And I always look as an investor going forward is it really doesn't matter what happened over the last 10 or 15 years. It's really what is likely to happen. What's kind of the foundational premise of how we're going to move forward in this market environment where, quite frankly, we've never really gone through this at this level. And so, everyone's trying to figure out, how's this going to play out? What is the ultimate end game?
Well, and so as the central bankers continue to pour stimulus into financial assets, I mean, we're looking at, and maybe you can share some of your thoughts. I mean, everything's got peak valuation today. We're trading at multiples that are unheard of. What are your thoughts on valuations in the stock market today?
I think they're, by most measures, they're at the highest ever. They're in the top, 100 percentile in terms of valuations. Effectively, I think there was a good article I read yesterday about how some of the FANG stocks have really now been priced so high that they're almost really priced as a bond going forward. And I think that's kind of where we're at right now. It's that those future gains that you like to count on have probably already been brought into the valuations and the prices today. And so how are you going to generate those types of returns going forward, remains to be seen. Clearly, some of the value stocks probably are better long-term plays than some of the growth stocks. But as you know, most of the money has gone into the momentum stocks of these companies that have done very well, especially in a COVID environment.
And at some point, this, we'll call this the stimulus addiction that we have as a global economy will have to end, I believe. What are the experts in your sector saying? I mean, are we getting closer to the end of, we'll call it, marginal impact of stimulus to the marketplace? I mean, it seems like they keep pouring more capital into the economy, and it's having less and less of an impact on market levels.
Yeah, the more debt you add to the system, the less growth you get from that additional debt that you add on. Of course, now we've seen the money that we've spent and allocated seems to be causing inflation at this point, which we haven't really had in decades. And that's you're starting to see a lot of short-term supply problems and inflation that's now becoming a problem that we haven't really had recently.
And it seems like a lot of the large asset management firms are now calling for just lower overall growth expectations. Would you mind commenting a little bit on that, of what you're seeing from kind of forecasts from different economists?
Well, like I mentioned this earlier, we go back to and say, okay, great, the market's done very well over the last 10 plus years. What really can it do now given the high level of valuations? And yeah, that creates big problems for people's portfolios when a lot of these gains have already been recognized in the portfolios today. And so can they really generate those? I think the markets are really going to struggle to generate those returns. And of course, I don't ever believe the markets just kind of stay flat and go up 2% a year or 3% a year, whatever that's going to be. More likely than not, we're going to have some type of pullback. And quite frankly, when you mentioned the Morgan Stanley call about a 10% sell-off, I mean, I think that would be quite frankly a gift if that's all it was at some point. And the next bear market is probably going to be one of the biggest ones we've ever seen. Just don't know exactly when that's going to occur.
Well, and that's the question for me that I think about is the central bank going to allow a complete fall out of the bottom of the marketplace, or are they going to continue to build this bridge to nowhere? And my biased perspective is that we have to really invest as a country and as an economy in quantum levels of improving productivity through technology to earn our way out of this, because I think we're in a global Japanese kind of debt trap. The question is, at what point, what would it take for the central banks not to stimulate or reinvigorate quantitative easing, in your opinion?
I think they're between a rock and a hard place. I don't think they can stop doing something. I think I go back to the original kind of Fed intervention was the '87 crash, and ever since then they've done more and more to kind of keep the proverbial party going. I think they're stuck. I don't think they can not do something or continue doing it. Now the question is whether or not the markets ultimately come to the realization that they can't fix this. And that's what I think is more likely. It's not that they're going to stop trying to intervene. It's just their effectiveness is not going to be, they're not going to be effective at some point. And the market's going to lead that down and just say, this can't really play out this way. I mean, I think your point is very valid about technology and the advances that we've had in terms of productivity. I don't know that you can overcome all that debt that we have on our balance sheets, as well as, quite frankly, the demographic trends. I mean, most countries around the globe are having less than replacement population growth. And so, without immigration, the United States would be actually declining in population. So I think that's the big headwind long term, is demographics are not in our favor at this point.
Yep. No, that's a very important economic concern, is, immigration policy, fixing human capital. We need to be bringing the best and brightest over here, as well as a competitive labor supply of folks who are willing to do the hard work to drive the economy forward. How are investors responding to this environment? I mean, some people are pulling back, sitting in cash. Some people are getting more aggressive and doubling down into FANG. What are you seeing in the marketplace?
Well, I think people are taking on more risk. I think people fundamentally, most people need market returns to meet their retirement goals and objectives. And when you have the fixed income environment that we're in right now, you've got to reach for yield or reach for risk to get those types of returns. And so people can't just sit on their portfolio and make 2 or 3% a year. They need to go for bigger gains. And I think that ultimately leads people down a path where when the next bear market does hit, it's going to be devastating, especially for those people that are either in retirement or nearing retirement, because the sequencing of returns is a big driver of people's retirement. If you hit a bear market at the beginning of your retirement, it really has long-term devastating effects on a portfolio.
So it seems that investors, like you said, have to reach for yield or reach for risk. Since the late '80s to today, it seems that investors have been, for the same nominal return, been having to step up the risk. Maybe you can talk a little bit about that.
Sure, and that goes back to the interest rate that existed back in the '80s. You could actually make a pretty compelling case just to invest in fixed income and the types of returns you could get. And this slide that we're talking about right now had expected returns about 7.5% with a very low standard deviation. As interest rates have come down over the last 30 years, you've really had to change the dynamics or the allocation of the portfolio, try to get that same 7.5% return. I mentioned earlier that very few investors out there are they're saving a certain amount of their income and their wages, and they're putting it away for the long haul, but they really need those types of returns to kind of reach their goals and objectives. And so as you've gone to today's environment, you've really had to add a lot more risk in the portfolio. In this example right here, the standard deviation going from about 3 to about 18% is a tremendous amount of risk. And as you know, most of the investors that are around today, notwithstanding the financial crisis that we had about 13 years ago, haven't really had a protracted long-term bear market that they've been through. And I remember the financial crisis really was about 18 months and it was over. But what happens if you've got another lost decade really is going to have tremendous negative effects to people's portfolio. And we all know human nature. Human nature is such that when you go through a bear market, people are apt to get out near the low and not really want to get back in the market in the future. So that creates that kind of gap between investor behavior and what they should do long-term when building a portfolio and managing their risk.
And that was a great chart, and it really left an impact on me. We're in a 6 times riskier environment than we've ever been for the same type of total return, and I think advisors need to pay attention to that. We've probably gone through 2 generations of advisors who have never seen a protracted downturn like you just mentioned. Can you talk about the need for a hedge for both sides of the tail? For one side maybe being market risk and the other side being inflation, and how hedging programs can help against both?
Well, fundamentally, investors always, in retrospect, look at types of returns that they expect to get in their portfolio and say, yes, I want that. I'm willing to do that. But we all know there's usually that gap between what they say they want to do and what they ultimately are willing to be able to endure. And so the concept of hedging really comes back to, if you create a portfolio that the investor can actually stick through long term without bailing out at the bottom or going crazy at the top, it really allows the client to be able to stay the course and give the investor a better experience. And you're alluding to the 2 types of risk to the investor. On one hand, you've got to be able to protect that principal. You've got to be able to minimize that drawdown during bear markets, but you also can't stay passive and just invest in whether it's fixed income or just cash at this point, because you've got the opportunity cost. You need to make some level of return for your portfolio, but also in today's environment with the inflation seeming to be picking up at this point, you can't lose purchasing power. So you've got to stay, we always say, stay invested, always hedge, and just create that return stream, a nicer, smoother ride for the client that allows them to stay the course.
So the defined risk strategy is the product that your firm offers. Can you just talk about the construction of the product? What is it actually? What are you investing in? What do clients get invested in when they buy this product?
Sure. When the strategy was started in the late 90s, and that's really when the ETF really were started. I think 1993, SPY was the first ETF. So our flagship strategy was always based on the S&P 500. So what that means really is investing roughly 90% of the underlying portfolio in a tax-efficient, cost-efficient ETF, get your exposure to the market. And so now Swan offers many different products on different equity markets around the globe. So, we're a believer in equities over the long haul. We try to structure out a lot of that volatility and that risk in that portfolio. So what we do to manage that market risk is be able to invest in long dated put options to be able to hedge out that risk. And we talked about the correlations. We know if the market drops 30 or 40%, we know what those put options are going to actually do. And so investing roughly 10% at all times in put options to be able to protect that portfolio is how we structure out much of that market risk. And so when we've gone through the 2 different bear markets, the dot-com bubble and the financial crisis, we had losses in the portfolio substantially less than the market in general. So we're very agnostic as to the underlying positions of the equities. So we give our investors exposure to the S&P 500, US small cap, foreign developed, emerging markets, whatever exposure you want, but structuring out a lot of that market risk by using put options. And of course, we engage in other types of option strategies to generate income or get more exposure, synthetically creating long positions in the markets by buying call spreads and things like that.
And I remember, Q2 of 2020, kicking myself for not being hedged better in the marketplace. Can you talk a little bit about how you guys roll the hedges and what time period, and why it's important not to try to time the falling knife?
Sure, I'll give you 2 examples. Our strategy is structured that we kind of re-hedge the portfolio every year, and we do that for 2 reasons. One is as time elapses on those options, you want to stay ahead of the rapid time decay that occurs in options in the last year, but the last half of the last year. So we're always rolling out in time, and that also allows us to adjust the strike price. As we go through a bull market, we're able to lock in higher and higher levels. So once we get to the end of the year, if the market's gone up 10 or 15% that year, we're going to move up the strike price. And we do the same thing in bear markets, right? And so I think last March was a great example of, we had a big sell-off in a short period of time. We're able to sell those deep in the money put options and profit on those put options and use the excess cash generated by selling the deep in the money option, buying another at the money option or near the money option, and using that excess cash to buy more shares. And that's what we've done really through the bear markets, is actually take advantage of market weakness, use those market weakness opportunities to really add to your equity position, but using the profits from the sale of the puts. And so it just allows us to kind of take money off the table on an annual basis, lock in those gains. And then when inevitably you have a bear market, it allows you to kind of reposition your portfolio to get back into more exposure to equities.
And is it just, call or put options, or are you doing any kind of structured collars for any of the hedges?
Well, we have many different products at Swan, so it'd be tough to talk about all those in a limited period of time. But what we try to do is, in our flagship strategy, where we're selling calls and puts short-term in nature, try to generate income. And so we don't like to structure much of the upside because we want to have exposure to the market. So we kind of treat our income strategies different from the underlying equity plus hedge, to be able to let the market run when it keeps going up. And as I said earlier, we have different types of strategies. Some products don't really have the income component. Some have more of aggressive income component. And some, like our growth strategy, that actually not only has exposure to the upside in the market through the long ETF long put option, but we actually buy additional call spreads that gives us synthetic upside in the market to give us more upside. So it covers the real gamut of what investors really want, depending on their own suitability and their own preferences for risk in that portfolio.
So would DRS be considered more of a long-term hedging program or a shorter-term hedging program?
No, it's a systematic long-term hedging program, always invested, always hedge. It goes back to our philosophical view of not being able to pick or time the market. We would even say the same things with actually picking stocks within those ETFs, right? We're not picking a specific stock or a group of stocks. We're actually just long exposure to the market. Once again, kind of under the principle that, we haven't seen the evidence that there's many stock pickers out there that can really beat the market over long haul. So it's really just exposure to the equity markets. I mean, we've all seen those long-term charts to say, yes, invest in equities are always great. Of course, we know there's decades or longer where equities don't really look that good. And it's just really, like I said, trying to give the client a better experience to be able to stay the course over the long haul to get exposure to equities.
And how does this product, fare versus, doing some of these inverse ETFs, some of the, you can double down, 2x the inverse of the market. I mean, what's the risk in those products versus doing a strategy like this?
Well, our risk is substantially less than any type of leverage product, and is even less risky, we would argue, than just the general markets because of our hedge. And so, you kind of look at the entire portfolio. When I designed the strategy in the late 90s, really it was to kind of replace the 60-40 portfolio, knowing that, of course, I did not foresee necessarily the interest rates going down as low as they did. But I did know that in, like, say, 2008, your 60-40 portfolio still lost 27%. And so that's a pretty substantial hit to your portfolio. So just kind of shows the weakness. Now, in today's low yield environment, it's more compelling. And it goes back to clients are taking on more risk in their portfolio. But if you allocate some of that equity or some of that fixed income that you would normally put to fixed income and you put it in hedged equity, you can get a substantial return without having that interest rate risk that you would in in fixed income, or even just the lack of ability to be able to make positive or significant income in your portfolio.
Especially if inflation's starting to, creep up into the total returns, right? The nominal returns of yield products. This next slide that we're going to talk about, it just talks about the variance, if you will, as it relates to unhedged portfolios and the 10-year track record. And obviously, some years have, bang out returns in terms of upside. But on the right side of this graph here, we have a very tight pattern of total return. And so one side, the left side is unhedged, the right side is hedged. Can you maybe explain this chart to us and talk a little bit about that?
Sure. This just shows the 10-year rolling average returns of the S&P 500 going back to the inception of our strategy. And on, like you said, on the left, it's got the unhedged version of the S&P 500. You can see the variation in returns are tremendous. I mean, obviously you have some very good decades in there, but you also have some zero decades and some lost decades. So as I said earlier, our goal really is to provide a smoother ride for our clients that allows them to kind of stay the course. And so at the end of the day, it doesn't really matter what the market did if you got out of the market or your timing wasn't good. And this also just kind of shows the timing of the issue of the market and the rolling returns of the kind of defined risk strategy. Really, it didn't really matter when you got into the strategy, that most of the 10-year rolling returns were pretty similar within a pretty compact range. And I think theoretically, that's what investors always say they want. Investment professionals always try to offer to their clients. I'm going to build a portfolio for you that smooths out the returns, smooths out the risk. And as I said, with using options, I think it's a much more controllable, much more efficient, effective way to manage market risk. And it's obviously more compelling now that interest rates are so low.
No, it is, and I think people sometimes get seduced with the upside of strong returns and don't realize that sometimes it's not their advisor that's the genius, but it's the central bankers that are stimulating the hard assets and financial assets. But it's that return of capital, not just the return on the capital, that's critical for retirement and for long-term planning. And so I think a hedge portfolio makes a lot of sense. Maybe we'll switch gears a little bit. Could you talk to us a little bit about just when you started the firm, what your background is, and kind of how big the firm is today?
Sure. I started my career out as a CPA. I worked for KPMG in Houston. I left at 29 had a kind of vision. I was an avid investor since really probably middle school, invested in stocks and bonds and gold and stuff like that in high school. And I really saw a need in the market to really address the market risk aspect of portfolio investing and saw some of the deficiencies in modern portfolio theory that you really couldn't diversify away market risk. And so that was kind of the whole thesis of starting Swan. Right now, we've got about 45 employees at Swan. Our offices are located in Durango, Colorado. The investment management team, which includes me, is down in Puerto Rico, take advantage of the awesome weather and some low tax environments down there. And we've really, over the last 5 or 6 years, really expanded our product mix to really not only give investors opportunities to access the different equity markets around the globe, but also within some of those, like the S&P 500, different risk return profiles, to give clients more choices that meet their kind of aptitude for risk and what their kind of goals are. It's been a great ride over the last 25 years or so. Obviously, we think that we're coming to some type of big resolution at some point with what the central banks have done around the globe, and we think the strategy is very uniquely positioned, not only due to the low interest rate nature of the markets right now, but the inherent risk right now in the markets of how this is all going to unfold as the central banks try to figure out how they're going to get out of this situation they've put themselves in.
Well, you're someone who watches, the U.S. market diligently. Are you also looking at international equities? And if so, what are your thoughts on the Chinese stock market?
Well, I think I would say that we've done very well with sticking with the U.S. market, but we do have products that obviously do invest in the emerging markets, which China would be obviously included in that. It's kind of interesting because you keep thinking that the S&P 500 can't keep doing what it's doing, but it does seem to be the best index around the globe. And, I kind of go back to what people aren't realizing about the global markets right now is that Europe and China really topped out, over a decade ago. And those markets really haven't done as well as they should have done theoretically. And so people always look to China about how great of an economy it is. And I think they have some structural problems with demographics also. In fact, I think they're rapidly becoming the oldest nation in the globe because their one-child policy has really created an issue. I know they've reversed that policy, but I think it's really hard to do that once you got that going. And so I think they're really going to struggle going forward. Now, of course, we think that, having an investor be exposed to all equity markets around the world makes the most sense, especially when you can do it on a hedge basis. So we're not against anything globally. We actually like the global markets, but it is true that I think especially Europe is 10, 15, 20 years ahead of the United States in terms of some of their demographic issues.
Do you think the U.S. dollar is at risk of losing reserve currency status in the next 20 years?
I know there's a lot of players around the globe that would love that to happen. So I think I take that risk seriously, and that would affect us a lot in terms of what, the debt structure and how we're going to be able to operate going forward. So yeah, I think that's a real risk.
And a question, a lot of advisors, look, it wasn't the wrong call to be in indexed or ETF products, but do you think they're overused today? And do you think active management comes back in the future?
I think everything goes in cycles. So I think active management will come back, and it's been hard to obviously beat an index fund that's low cost over the last 15 years. Absolutely. But no, I think long-term, I can see some of the bubbles forming in terms of the FANG stocks and the tech market right now that, people forget that after the dot-com bubble, I think tech lost like 80% of its value over a couple year period. So we'll see how that plays out. But I definitely think value is going to come back and play at some point.
Yep, I agree with you totally. Well, in season 4, we got a few questions we'll be asking all of our guests, and I'll just kick it off. They're either yes, no questions or quick answers, as much context as you want to share. Who do you follow in your industry for best ideas?
Well, as our company is just really focused on the hedging and the option strategies, and I think we really don't get in too much of the macro in the sense of how it's going to really change our strategy. But, I like to read just really a little of everything to kind of get everyone's viewpoint. But once again, we don't really change our strategy based on that.
Got it. Any books you're reading now that you'd want to share?
Yeah, actually, I just finished reading the book a couple weeks ago called The Coming of Neo-Feudalism. The author is Joel Kotkin. He's a recovering Democrat, and he's now claims to be an independent, but he makes a really compelling case of it's really no longer the Republicans versus the Democrats or conservatives versus liberals. It's really about the coming oligarchy and how they're trying to consolidate and control power and really make it where 90% of the population really becomes serfs. And he makes a pretty compelling case of how things have really changed in our economy. And it really kind of moved my view away from, okay, let's increase the social safety net of our society, which I'm not necessarily for, but it really, like I said, pits the ruling class. The clerisy is what he uses the term of. That's the kind of media and Hollywood and academics and stuff like that have kind of gotten into bed with a lot of the tech and big business to kind of really consolidate their power and really make it very difficult for the average person out there. And that's his real whole point, is that it's going to be harder and harder to have upward mobility in this kind of structured economy that we have right now.
No, I agree with that. And I think, technology can be a tool used for, libertarianism and individual freedom, or, totalitarianism and control of populations. And I really do think it's about, globalists versus libertarians today. And it's not just Democrat, Republican. And I think as soon as we get the lexicon right about what we're actually fighting about and the worldviews, it's going to have an impact on fault lines within parties, but also within societies. Do you think there's another shutdown coming this winter?
I do not think there's going to be another shutdown. I just don't think there's political. I think the politicians are really going to struggle doing that. I think we've gotten to the point where, you either have been vaccinated or you don't necessarily want to get vaccinated. So no, I don't think it's going to get worse in terms of them trying to shut things down.
It's interesting. People, myself included, we're not very happy with the president's remarks about forcing vaccinations on employers. But I didn't realize there was an article I read this weekend about smallpox and a Supreme Court case that the Supreme Court said that an individual's liberty cannot impinge on another individual's liberty. And so by not getting vaccinated, you're impinging on your neighbor's liberty and society in general. So they forced people back in New York City in the late 19th century to get smallpox vaccinations in police stations. And that's a part of the history that I'd never read before or heard about, but it's fascinating that there's actually Supreme Court precedents here for the president's remarks. So that woke me up over the weekend, and I think we've got a very strong set of conversations to have in the coming months. Well, we all went through the shutdown in 2020. I don't know if you've had a COVID vacation to make up for 2020, or if you got one on the horizon. What's any best vacation spots you'd want to share with our listeners?
You know what? The place I would like to go when things kind of open up again is going down to South America. I went there about 4 years ago. Really liked Argentina a lot. It's a very beautiful area. It's got amazing topography, and of course, most people always like to go to Europe. Been to Europe many times, but I think South America is kind of undiscovered for most Americans.
Absolutely, it's our backyard as well. What advice, if any, could you give financial advisors? You deal with them a lot. What are some of the best financial advisors doing, in your perspective, to grow their businesses?
Well, I think they have to have honest and frank conversations. What's realistic going forward and the risks out there in their portfolios. So I think those advisors that actually get the big picture and are helping their clients make the right decisions are the ones that are going to succeed the most. As we enter this next phase of getting out of this pandemic, and how we move forward, how the economies and stuff like that are going to open up, it's going to be very interesting to see how they can pull the proverbial rabbit out of the hat.
Randy, how can people find out more information about Swan Global Investments?
I think the best way is just go to our website, swanglobalinvestments.com. We have a lot of literature, and we do a lot of white papers and research for advisors as well as individual investors. We've got a great team that we've put together that really do a lot of good research that kind of discuss all these issues, whether it's risk or fixed income, the dual dilemma of equity valuations with low yields right now in today's market. So that's a great way to do it. And then obviously people can always reach out to some of our sales personnel to help them out for advisors.
Randy, I couldn't agree with you. Your product's very compelling. It's helped shape a lot of my thinking about risk in the market. And I really thank you for joining us and sharing your thoughts with our listeners.
I enjoyed it very much. Thank you for having me on.
Thank you very much. And that's the end of Non-Beta Alpha. Thank you for joining us. Until next time. And now you know.
Thanks for listening to this episode of Non-Beta Alpha. Don't forget to follow us on Instagram and Twitter, and subscribe on iTunes, Spotify, and YouTube so you never miss a show. While you're at it, if you found value in this show, we'd appreciate a rating on iTunes, or simply share this episode with your friends. And now you know.
All price references and market forecasts correspond to the date of this recording. This podcast should not be copied, distributed, published, or reproduced in whole or in part. The information contained in this podcast does not constitute research or recommendation from Non-Beta Alpha Inc., Wentworth Management Services LLC, or any of their affiliates to the listener. Neither Non-Beta Alpha Inc., Wentworth Management Services LLC, nor any of their affiliates make any representation or warranty as to the accuracy or completeness of the statements or any information contained in this podcast, and any liability, therefore, including in respect of direct, indirect, or consequential loss or damage, is expressly disclaimed. The views expressed in this podcast are not necessarily those of Non-Beta Alpha Inc. or Wentworth Management Services LLC, and Non-Beta Alpha Inc. and Wentworth Management Services LLC are not providing any financial, economic, legal, accounting, or tax advice or recommendations in this podcast. In addition, the receipt of this podcast by any listener is not to be taken as constituting the giving of investment advice by Non-Beta Alpha Inc. or Wentworth Management Services LLC to that listener, nor to constitute such person a client of any affiliate of Non-Beta Alpha Inc. or Wentworth Management Services LLC. This does not constitute an offer to buy or sell any security. Investments in security may not be suitable for all investors. An investment of any security may involve risk and the potential loss of your initial investment. Investors should review all risk factors before investing. Investors should perform their own due diligence before considering any investment. Past performance is not indicative of future results. Investment products, insurance, and annuity products are not FDIC insured, not bank guaranteed, not insured by a federal government agency, may lose value.